The RBA cut Australia's cash rate by 25 basis points to 3.6% in August, the third reduction of the easing cycle, with a tone that was slightly more dovish than I anticipated. The updated forecast for the cash rate path tell the story. The RBA has downgraded its longer-term productivity growth assumption from 1% per annum to 0.7%, yet still sees trim mean inflation holding near the 2.5% midpoint of its target over the next 2 years. Unemployment is forecast to have already peaked at 4.3% and to remain there until the end of 2027, underpinned by the assumption that the cash rate will be reduced another 3 times, one more than the profile used 3 months ago. Inflation is expected to stay anchored despite additional easing because GDP growth forecasts have been lowered for the next 2 years. The bank has also cut its estimate of Australia's trend growth rate from 2.25 to 2% due to weaker productivity. The August statement of monetary policy underlines the focus on productivity with 231 mentions compared to 212 for inflation and 34 for unemployment. In the near term, unemployment data due Thursday will be pivotal for the outlook, given its influence on wages growth and consumption. With no full monthly inflation survey until late October and the RBA's preference to adjust policy after quarterly CPI, inflation is unlikely to drive decisions until late September at the earliest. Today's decision lowers the bar for further easing, in my opinion. Markets see at least another cut by year end, most likely in November after Q3 CPI, with 2 full cuts priced by middle of next year. Any rise in unemployment could accelerate that timeline, and that is a material risk given the current trend.